You need to be a little less risk averse. You need to be willing to take more risks when it comes to investing. So even there, though, in the beginning, I was pretty risk averse. I was only going with people after I had done my due diligence on them personally.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Keshav Kolur. Keshav is a full-time real estate investor and the principal and founder of Clive Capital. It's a private equity firm based out of New York City. And since founding Clive Capital, Keshav has helped investors allocate capital to 7 properties with a combined asset value of more than $150 million in projected growth to $300 million over the next 5 years. That portfolio spans 900 plus apartments under renovation and 500 more under construction across 3 markets. Keshav, thank you for joining us today. How are you, sir?
I'm doing well. Thank you, Neil. Thank you, Clint, for having me on today. It's an honor.
Yeah, absolutely. We're happy to have you here. So we were talking briefly just pre-recording here. You've got a pretty well-rounded background, what you were doing previously as a software engineer for Amazon and Facebook, but you're also really well-rounded in the real estate space. So tell us a little bit about how you got invested or involved into real estate and then what you're working on now.
Yeah, I started out, probably about 6 years ago now in real estate in general, maybe 5.5. Out of college, I read Rich Dad, Poor Dad, and that's what really got my gears turning about, hey, I should get into real estate. I think it had always fascinated me. My mom, would always tell me that when we lived in Denver, when I was like 2 years old, the only way to get me to go to sleep was to drive around downtown and to get me to look up at the big buildings. So, there was that. And I always had the monopoly bug too, but no one I knew was in real estate. So, went into college as an engineer because that's what, we had known, and that's what was pretty simple, the straightforward W-2 path. But once I found and read Rich Dad, Poor Dad, that got me thinking about real estate, specifically rental real estate. It didn't have me thinking about what we do now, syndications, just yet. But I got my realtor's license on Leap Day of 2020, actually, February 29th. And then, as we all remember, 2 weeks later, COVID hits, the markets shut down. And later that summer, though, put my realtor's license to use, helped folks, sell homes, get into some homes, had some cash saved up from that and the day job, and started looking at rental properties. Luckily, though, before I went too far down that rabbit hole, one of my good friends from college, he came across a Reddit thread where someone was talking about how they had 40 rental homes. And he mentioned that they were pain in the butt and that buying apartment buildings and managing them is a lot easier. 1, more lucrative. 2, better tax benefits. And, it can be passive if you want it to be. But at the time, I thought this was too good to be true, right? So I reached out to that person, did my due diligence, went to his networking sessions, kept branching out in the industry, met a lot of different people. And so over the next year, from September of 2020 to September of 2021, networked, analyzed deals, read books, watched YouTube videos, really got comfortable with the space, made my first investment into 108 apartments in San Antonio. Started seeing the cash flow coming in. And at that point, it was a proof of concept to me that, hey, this works. This isn't a Ponzi scheme. And started my company in January of 2022, Clive Capital. And our goal is to help tech professionals build passive income, generational wealth, financial freedom, reduce their tax bill, all that good stuff through passive private equity investments. So far, we've helped our investors, primarily folks from Meta, from Amazon, because I run investment clubs at both of these companies, Google, just big tech companies in general, invest into I think now we're at over 1,000 apartments and under renovation, 500 single family homes under development. We're expanding into industrial real estate, triple net leases. We're doing private lending and oil and gas primarily for the tax benefits. So the goal is diversification. The real estate's the foundation, but then looking beyond real estate, how can we get into new asset classes that others haven't discovered yet for outsized returns?
And you're moving fast during a time period that has had a lot of economic headwinds and challenges over the last couple of years. So Neil and I say the people that are operating over the last 24 to 30 months are typically a different breed. It's been extremely challenging. And so it's interesting to me to see you switching to multiple different asset classes. Did that come by necessity of what we saw with the capital markets really putting downward pressure on the multifamily syndication? I'm assuming that a lot of these projects that you're taking on, you're buying B or C class projects that need some level of renovation, right? You're making it nicer. You're increasing the net operating income, which increases the value of the property. And then you're going to have some type of exit in order to have a payday for yourselves and your investors. Is that the model?
Yeah. And again, to clarify, I'm a fund of funds manager here. So I'm partnering with companies who are doing this, who have the expertise. And so that's how I'm able to get into all these different asset classes, is I have partners, companies, and people that I trust who are experts in these respective areas. But that is, on the multifamily side, that's our operators' business plans. Get into these B and C class buildings. And whether that's bringing them up to market through increased rents and renovations and modernizing the interiors, whether it's cost cutting, whether it's tax advantage programs, tax credits, things like that. Some way to add value, improve the bottom line of the apartment building. That's the name of the game.
Gotcha. So I don't want to belabor this, but obviously, in the multifamily space, there's been a lot of challenges. I've heard you mention previously that, one of your early limited partner deals you invested had to pause distributions due to high leverage and floating rate debt. What kind of lessons did you take away from that experience, and how's it shaped what you're investing in now?
Yeah, luckily for me, I at least had the smart idea of putting my own money in first before bringing any investor capital along for the ride. And I've done that with real estate when I invested into my first oil and gas deal, because that was a whole new world to me. I did that as well. So there I learned that, if you're, I'm not going to say floating rate debt is bad, but if you're using floating rate debt, you should really know what you're getting into, be really confident in the team, and just make sure you're being extra conservative and understand what the risks are, right? At the time, because it was my first deal, I didn't know all that much. As an LP, of course. Luckily, all of the opportunities I felt my passive investors invest into, it's all been fixed rate debt. So sleep a lot better at night on those.
So I love that you're coming to this from a fund of fund perspective, where you're raising capital from groups of investors, specifically investors that come from your same background. I think it was brilliant to start investing clubs at the two companies you're at previously, Amazon and Facebook. Obviously, that's a situation where a lot of those employees are going to have capital that they could be investing, but they don't have time, right, to go find the right person to invest with, and they don't have experience, right? So you're bridging a gap. You're right. There's a need gap between the capital that those people have and then the time and experience that they're looking for with the right general partner. So you're putting yourself in basically a trusted advisor position, where those people recognize the conversation with you as they're speaking with someone that's a peer, that's coming from the same background, but that you are identifying good operators in the space so that they can trust you to invest together and hopefully get either a lower minimum or a higher return by investing with you versus what they could get with that operator individually. How have you identified operators that you want to partner with, or who you're willing to raise capital for when things have gone wrong for a lot of people over the last couple of years?
Yeah, I took a year, right? That first time around when I got comfortable from hearing about it to actually pulling the trigger. So I've used to be fairly risk averse, take things very slow, just because that's my background as an engineer. We're taught to be very analytical, very risk averse. Specifically, I was a mechanical engineer, right? So if you're building planes or bridges or cars, you want to make sure that there's a 1 in a millionth chance that whatever you're building breaks. On the other hand, I think you need to be a little less risk averse. You need to be willing to take more risks when it comes to investing. So even there, though, in the beginning, I was pretty risk averse. I was only going with people after I had done my due diligence on them personally. So I read books like The Hands-Off Investor, for example, by Burke, that shows you how to vet people in the syndication space. And there are plenty of other, assets out there where people have put together checklists. We have put together our own 100-point checklist, questions you should be asking your GP, your operator, your fund of funds manager, whoever you're investing with, regardless of asset class. Just general questions. What was your background? What's your investment thesis? Tell me about a time a deal went wrong. Give me your testimonials. And that's actually on our website, clivecap.com/alternative-assets. So starting out, I went through that interview process of asking 100 questions or so. Any partners of mine that you talk to, they will tell you that I'm a pain in the butt and that I ask a lot of questions. So I think that's necessary. I'm also part of a few, networking groups in the industry. Raise Masters, Connected Capital, Avestor, which is what I have my funds through. So having that network also helps, where people who have a decade, 2, 3 more experience than I do, 3 more decades, I can rely on, their good word. Once I've verified that they're the right person, they can kind of act like an anchor for me. Like I can go to this person, get their gut check on, go to Jane, get her gut check on Janet, who I just met in the industry. So all that to say, in the beginning, I had to establish those anchors. So I went really deep as far as, going through all 100 questions, for example, to vet this person. But now I have enough people that I trust in the industry where if I wanted to get into raising capital for small businesses, I have someone that I could reach out to, whether it's a first connection or a second connection. I'll still vet them. And if I deem the venture too risky, I will still put my own money first. But that's how I've come to establish a network and have the ability to expand into different asset classes outside of my own. And then once I find this person, then I obviously take it upon myself and my team to ramp up as quickly as possible on this new asset class.
So you've got your 100 question checklist, questions that you use to vet different sponsors. What would you say are, let's say at most 10 questions that you have to get answered, and you have to get the right answer in order to proceed with that sponsor?
I think number one, probably the most important, is testimonials. It should come from a variety of sources. It should come from investors, bankers, right? Like their banking partners, insurance partners, attorneys that they work with, any title companies, things like that. Any institutional partners that they have helps as well. Whether it's brokers or capital sources, those always go a long way. And then just their track record, right? Let me see your past investments. Let me see how they performed versus what your projections were. I want to see an example of a deal that went bad also. And if it hasn't gone bad, I really want to know why a deal hasn't gone bad. Because if you've been in this industry long enough, a deal has gone bad to some extent for you. And then when it did go bad, how did you communicate to investors, to your other partners? What did you do? What did you learn? And then an example of marketing materials too, right? Let me see a sample pitch deck. Let me see your website, your investor portal, your investor updates, your emails, like how do those look when you get your K1s out, really learning about their operations and making sure that it is a smooth sailing ship. I would say those are some of the big questions. Oh, and then just their personal background, right? Like this is more of a gut check, but what was your background? What did you give up to do this, right? If you gave up, $500,000 corporate job to do this, then I know you have more skin in the game than someone who gave up like a $40,000 job to do this, right? You have more to walk away from. So just things like that, like your personal journey. Can I connect with you? Do we align on values? Things like that.
I love how you're like, well, if a deal hasn't gone wrong for you, then why not? Like that, yeah. Well, a lot of people will be like, "Oh, that's great news," and you're like, "That doesn't make any sense." I'm in this space too. Why not? You're not trying hard enough if someone hasn't gone sideways on you. One of the guys I was talking to recently told me, like, "Look, if you're in the multifamily space, then you're walking with a limp, and if you're not, you haven't been doing it long enough." Like, there's a lot of young running quarterbacks in the NFL, and there's not a lot of old ones because they've taken some licks. So. Talk to me about you're looking at industrial, you're looking at several different spaces right now. What are you looking at the industry and what do you like? Obviously, everybody's looking for diversification. right? And typically that needs to be different assets, different geography, different operators, different debt structure, different time cycle, paying out in a variety of different ways. But what are you looking at in the space that is attractive to you right now? I know you mentioned like some of the light industrial and things like that. You're looking at build to rent communities. Obviously, we're in a housing crisis and have been for a very long time. So variable rate and bridge debt have really put a lot of pressure on the multifamily space. But as long as we have more people than we have places to live, I think that there is some cushion there. Especially the build to rent communities, I think are very unique. And because they oftentimes come with multiple exit strategies, you could package the whole thing up and sell it. You could sell them individually. There's a recapitalization that can happen by refinance. So what areas do you like right now? And what's your diversification journey taking you on based upon what you're looking for your investors?
Yeah, when we started out, it was pretty vanilla, and it's the easiest to wrap your head around, right? I have a single family rental home that's one unit. Maybe I work my way up to a quadplex. But beyond that, it's pretty intuitive to say, hey, more units, higher buildings, larger footprint, more floors. So multifamily is where we started because it's the easiest for people to understand. And, for those, we generally target a 15 to 20% IRR conservatively. These are just projections, of course. But over time, I've just been introduced to more and more asset classes that have had to, and obviously talked to more and more investors, learned their pain points too. So over the last 4 years, we've come up with six criteria that we look at investments from now, just from our own experiences and talking to investors. Number one, and the easiest one, pretty straightforward, is appreciation, right? Just your growth over time. Second, I would say, is cash flow. One of the reasons we like real estate and alternatives is because the stock market, dividend stocks are paying you like 3-4% a year. It's not that great. And real estate, for various reasons, we can cash flow a lot higher. So that's number two. Number three is tax benefits. So real estate has a lot of great tax benefits compared to the stock market, which is honestly sad at this point, just given everything I've learned in the alternative space. But with depreciation, if you're not in the real estate space or your spouse isn't a real estate professional, if we want to get completely into the jargon, it's an IRS designation. If neither of you are a real estate professional, those depreciation benefits can only reduce your passive income, right? Your income from the investment itself. It cannot reduce your active income, your W-2. And for me, in the tech space or my investors in the tech space, that's one of their biggest tax liabilities is on their active income. Especially in areas like the Bay or New York City, you're paying upwards on your top tax bracket of 40-45% on your top dollar. So tax benefits that, can translate over to W-2 income or other kinds of income has been a big focus of mine. Oil and gas, the investments that we make, every 100K invested, we have been able to so far reduce our taxable income by about 80K. For passive investors, you don't have to be in the oil and gas industry. This goes up to, you can reduce up to $250,000 of W-2 income, I believe, and an unlimited amount of capital gains. So tax benefits is third. Fourth is liquidity. We were talking before the show, or maybe even on the show. Some people want debt deals where they have a 90-day lockup. Other people, right, they feel more comfortable with the 7-year lockup in a real estate deal. So having a variety in lockup periods has been huge for us as far as the investments we look at. In addition to that, charitable investments has been huge. Some people like impact investing. That's something they're interested in. And sixth, risk, right? You have very safe investments like multifamily and industrial and self-storage that are very recession resistant that people will always need. And then on the other end, you have the very extreme is like Trump coin, on risk, but really high reward too. So those are kind of the 6 axes that we have been looking at. And right now, for me, I've gotten pretty comfortable with multifamily and industrial. Honestly, most kinds of real estate, except for maybe office and retail, especially since COVID, those I still need to get a better grasp on. So real estate and private debt, I have a good level of comfort with. Now I'm looking at opportunities that offer outsized tax benefits like oil and gas. And I'm also looking for investments that just have higher rates of return without significant higher levels of risk, right? Can we hit a 20% IRR or 25% IRR? That kind of thing. I'm not giving up on multifamily though. Like that will still be, or self-storage or industrial. It's going to be a bedrock of our thesis.
Yeah. I mean, there's my thesis for a long time has always been, invest in asset classes that have demographic tailwinds behind them. And I still maintain multifamily, self-storage, even mobile home parks, assisted living, like all those asset classes have massive demographic tailwinds behind them. And so I don't think that's going to change.
Not
probably
for a decade.
Not for a couple of decades.
Yeah.
I'm curious, you mentioned the tax benefits of oil and gas. What's the mechanism that makes it such a tax efficient asset class?
Yeah. So the business strategy there is we go in and we have landmen in the industry, similar to how we have realtors and real estate. Landmen track the transactions of, mineral land. I think someone was telling me there's a Netflix show on it, and that's how the term is becoming more popular. So these landmen will keep an eye out on how land transacts. And once they start noticing a big company, let's say Exxon, for example, going in and buying a lot of land in an area, then that means they know that Exxon knows that there's a deposit there of oil and gas. And these oil and gas companies usually pay geologists to do studies under the ground to find these deposits of oil and gas. So once the landmen know that they're buying in this area, then, our landmen will let us know of that. We go in and buy land in the same area as well. And as long as we're in a vicinity of that land, of like where the drilling is going to be happening, as the landowner, we get a portion of the revenue, 15 to 25% of the revenue. It doesn't have to be on the exact spot because, now we have fracking, right? You can, just because you drill here doesn't mean you have to extract oil and gas from here. You can frack and go horizontal and extract there as well. So that's why you don't have to get right on the pinpoint of where the drill goes into the ground. And then secondly, we acquire what's called a working interest in the land. And what that means is if the company needs additional capital for whatever reason, you will have to pony up capital. But my partner that I've invested with, she's been doing this for decades. She's only had to come out of pocket a few times and for not more than a few $1,000s. The risk there is pretty low. And but on the upside, that acquiring that working interest allows you to get the tax benefits, even as just a landowner. You don't have to invest into the drilling company itself. And the reason that it can actively reduce your W-2 income too is that in the first year, at least, you are classified as a general partner in the opportunity. In year 2, you're transitioned off to a limited partner position. My guess is back in the day before the shale revolution and fracking and all that, it was pretty risky, right? It was either you hit big or it's a dry well. So they had to incentivize it somehow. So this was the way to incentivize investments into oil and gas drilling and exploration.
Yeah, you either hit it, you could miss it by 10 feet or miss it by 10 miles. You don't really know, and you're hosed, versus now you get close and you get close enough, then through fracking you can have access there. Why is it, I didn't realize, how are you taking the depreciation there since it's literally just land? So we can't depreciate land. We're buying old Kmart buildings and stuff like that. We convert them to self-storage. As soon as we get the CO, we do the cost segregation study. We can take the accelerated depreciation, usually 25 to 35%, something like that. When you guys are buying land and doing mineral and oil gas extraction, where's the depreciation coming from?
The depreciation is coming from the equipment. I'd have to dig into my K1 a little more, but that's the only other thing that you can depreciate really is the equipment, because you acquire a working interest. You're allowed to do that. Again, the risk there is if the company needs more capital, you have to pony it up. But again, that risk is really low. And then there's also the depletion allowance. So that's a separate kind of tax deduction where the government says, hey, we understand this is a depleting resource. We're going to give you a write-off. I believe it's 15%. I think it's the first 15% of income that you make, like every year or something, that goes untaxed. So only 85% of that goes taxed. I'm still new to this space, so I'm still getting my head around it, but those are some of my understandings of where the tax benefits come from.
I knew that there were tax benefits, and we keep hearing oil and gas is a great place, especially if you're looking for like year one depreciation. Because a lot of times, like if it's a development deal within real estate, a lot of times you have to build out that development deal. For us, we're doing these conversions. We have to finalize that construction project before we can harness that accelerated depreciation. So a lot of people are looking for it in year one, but it may come in year two because it has to come after the CO, right? The certificate of occupancy. But I've always heard that oil and gas was a great year one depreciation model. And I was always curious about that because I was like, how? It's a square of dirt. But I guess the reality is if it's the equipment and you can depreciate 100% of it up front, then obviously it makes a lot of sense. And then if they're realizing that this is a depreciating resource that you're tapping into and you can write off 15% of that per year, that makes sense too. So good to know. This is the first time we've talked about that. Let me ask you this. You're raising capital through a fund-to-fund structure for multiple different operators, different asset classes, different geography, at different time cycles for your investors. And one of the things that you mentioned is that in your bio, you talk about being open to a customizable evergreen fund. It's something that we're looking at as well. So selfish question here. I want to know what you're seeing there in terms of the appetite for investors. I kind of see like a debt fund or an income fund, traditionally speaking, is typically like somebody's going to put capital into that fund and it's going to be either first or second position debt for multifamily or something along those lines. If it's first position, maybe it's paying 10%. If it's second position, maybe it's paying 12, something like 90-day liquidity, a seasoning period. People can put money in and either take monthly or quarterly distributions, or they can allow it to compound, which seems to be pretty attractive these days. So what kind of fund are you putting together? What's that money used for? And how is that being received by your investor base?
Yeah, some of the opportunities we have right now, unfortunately, because I'm talking about them, these are for credit investors only, but the number one on our list is oil and gas. Every single person that reaches out to me, their first thing is always, hey, I heard you talking about oil and gas. I want to learn more about that. My hunch there is the stock market is going bonkers. And so they think it's kind of cute. They think they're getting 30, 40% return, whatever it is. But I always tell people that until the money's in your account, I don't care about what returns you're telling to me, right? It could be 40% right now, and it could drop 10, 20% next day. Just ask NVIDIA employees 2 weeks ago when DeepSeek hit the market. So that's number one. The returns we used to project in real estate, 15, 17% IRR, to them isn't cutting it anymore because, again, they think their portfolio of Magnificent Seven is just killing it. Why take money out of it? So I would caution investors against that. Like, until the money is in your account, do not call it a return. So you can call it a projected return, but don't act as if you have that money already because paper money can vanish at any time. But the oil and gas is something they can't get in the stock market. So I've noticed that the tax benefits there is unparalleled. Second, they do like the consistent income and the mitigated risk of debt. They like monthly payments. And I think for people investing for the first time outside the stock market, equity is a lot harder for them to wrap their head around in a syndication. They can't track the price of their syndication shares into a multifamily investment or, God forbid, a development deal like they can in the stock market. So seeing monthly returns, it's like a proof of concept for them and they feel more comfortable with that. So I found that debt deals with a short liquidity period, 1 year or less, does really well next. And then I would say below that is multifamily, value add. And because at least you're getting cash flow then, and then below that is development deals right now, because you're not going to see any capital, any cash flow for like 3-4 years. And that's a mistake that I made early on. I thought people would love real estate, but it's kind of hard to tell people to believe in something if they can't see the results of it through the form of monthly or quarterly cash flow payments. So
yeah, boy, we live
preaching to the choir, brother. Yeah. Like that's the biggest thing. Like we are developers, and ours are development deals. It takes us a year to build a project out, and then it's worth a lot more than when we started, but it's empty, right? So we take a 100,000 square foot Kmart. Now it's a Class A climate controlled self storage facility, but it's empty. Now we got to fill it up, right? There's a lot of people that love that idea. But but it's hard to have patience. And so the people that know, like, and trust the operator, those are the people that come on board. But as you get farther and farther outside of that circle of trust, it's really hard to continue to scale in that model. So I get it. And it's so funny, like our job as investors for ourselves, but also like for capital raisers, for our investors, and you as a fund to fund guy, like we have to listen to what the market is giving us, right? We want to identify operators that are doing a great job of executing a business plan in economic headwinds. And then we want to listen to the market and what the investors are telling us they're looking for. Even if it's something like a debt fund and that nice, consistent, lower income, but coming monthly or quarterly with 90 or 120-day, 180-day liquidity, whatever it may be, is so much more attractive right now. Whereas 3 or 4 years ago, you couldn't get someone to look at a debt fund because everyone, you couldn't miss. Every multifamily, syndicator out there was hitting home runs. You couldn't miss. Everybody looked like a genius. And it's Warren Buffett says you can't tell who's skinny dip until the tide goes out, right? You really have to have that exposure in the market of the interest rates shooting up higher and faster than history, that the bridge debt was exposed, the mezzanine debt was exposed, and it really changed things. And all of a sudden people were like, you know what? I'd rather make a little bit less, but get it sooner. And I also think some of it is people are still really worried about what's coming in the future, and there could be opportunity. If there's opportunity in the future, then what you need is liquidity, which means I need to be able to get my money back out. Instead of in 4 or 5 years, I need to be able to get it out in 4 or 5 months if I see something that I want to move on. So it's interesting that you have to kind of adapt and move in that space. Talk to me about what's the exit strategy that you guys have put together for the build to rent communities that you're working on in Alabama and Louisiana.
Yeah, for those, one of them right now, our very first one, 100 units that we're building, about 100 that we're building. They're under construction right now, like wood's going up. We just finished our first round of 6 homes, and every month hereafter, every month or maybe 6 weeks, we'll have another 6 being finished. So that's where the first one is. The second one, we're getting ready to move on horizontal construction, also in Lafayette, about 241 units. We're building the utilities and the infrastructure in for the first 100 units, 93 to be exact. The last community in Foley, Alabama, it's about 160 units. We're holding there just to see, hey, is there already too much supply coming onto the market? And insurance rates have shot up too because it's right on the coast. So we're just kind of waiting and seeing what we should do there. That's the status of those. As far as exit opportunities, I would say there's 4 unique ways to exit in build to rent and maybe even development in general. One is obviously once you've completed entitlements, you can exit then. Second is at the horizontal stage. Once you've put utilities in, you can exit to someone else to go finish the unit build out. Third, you can finish the unit build out, but not lease up. A lot of the big companies, one of our partners actually, even though they're a multifamily operator, they buy built to rents that are completed, but not leased up, and they finish the lease up. So that's another exit strategy where you finish the construction, but you hand off the leasing to someone else. And then the fourth one is stabilization, right? You get your families and tenants in there, you get them, renting from you, everything's stabilized and everything's turnkey, and then you exit then. And you can exit to an institutional group and package up a bunch of these communities. You can sell off, bits and pieces of it. You can sell off one at a time as rentals. It depends on, local regulations. Actually, some of the communities we're building in, they've actually told us, hey, we're not going to let you sell this off to just mom and pop operators. We want this to be professionally managed. So we're not going to let you piecemeal this community. It's going to be sold. If it's going to be sold at all, it's going to be sold as in one package, all of it. So that also factors into your exit strategy and who or what groups you can sell to.
Yeah. So you got your hands in a lot of different areas right now, and seems like you've got a great basis of investors because of your background, and you've positioned yourself as a subject matter expert, and you've got a group of people that are listening to you in their direction they're following your direction as to where they're going, and you're creating opportunity for those people with different offerings, different return profiles, different assets, different time cycles. So what's next for Clive Capital? Like, you obviously have done a great job of listening to the market. Where are you headed? What are you doing? Are you continue raising capital for other operators? And where are you 5 years from now?
Yeah, for me right now, we launched our Evergreen fund that I think you had mentioned before. I don't think I got to that, but we launched an Evergreen fund, Clive Capital Fund 1C, for accredited investors only. And an Evergreen fund is amazing. It's with Avestor. Shout out Avestor. So the big benefits of going through Evergreen fund there's two sides of the coin for me and for my investor. For me, I can put all of my opportunities into one portal, and that's one login for the investor. Rather than having to go through 8 or 10 different, InvestNext portals, they can come to one place and see all of their opportunities. For me, it streamlines it because on my end, it's also just one place where I have to go. The accounting is really simple. The team handles all of that for me. And the distributions are really simple, just one bank account per fund. And then for my investors, they can, again, one login. So it's easy for their, spouses or partners to come in and see their investments too. And they also get one K1 or, one tax form for all the investments that they make through the portal. Rather than 10 federal K1s, they get one federal K1 for their investments. And then, yeah, it's just easy for me to bring in multiple investment classes onto one place. So it's scaling out that fund. Right now, we have an industrial opportunity in there and a private debt opportunity in there. Oil and gas, looking to do more of those, even though it's outside the Evergreen fund. To pass on the tax benefits, it has to be. That's something we're really excited about. And then, as I mentioned, finding other tax advantaged investment opportunities. I've heard solar has really good opportunities for tax benefits. There's charitable investments that are both, altruistic in nature and have great tax benefits too. And small businesses is an asset class that I'm really interested in, with the, silver, I think it's the silver tsunami that they call it, coming in. Being able to acquire those, I feel like that space isn't saturated yet. I'm not 100% sure, but I think that'd be pretty exciting too. So it's finding more investment opportunities that, optimize different parts of the 6 axes of our investments that we mentioned. And then just spreading our message that, hey, the stock market isn't the only vehicle for you. You can have great appreciation. You can have great cash flow. Again, we target, I would say, 15 to 30% IRR typically projected on our investments. There's tax benefits, there's cash flow, there's all this good stuff. So just trying to educate more people on this world of alternative investments, and then help them build a great diversified portfolio that fits their personal investment goals, and just get them to whatever it is: financial freedom, work optionality, all that good stuff.
So within the Evergreen fund, are people making one investment into the fund, and then it's basically a mutual fund that's spread out into these different assets, or they get to choose which part of it they're invested in? How does that work?
Yeah, that's a great question. And I appreciate you bringing that up, Clint, because that's something I should have mentioned. They get to pick what investments they want to get into. So I try to bring 5 to 10 a year investment opportunities, and they can say, hey, Keshav, I love investment number 1. I'm going to go all in on this. And I can bring them investment number 2, and they can be like, hey, Keshav, are you crazy? Why would you ever do this? And they can choose to pass on that one and only get the returns, only get the tax benefits for opportunity 1. So that's another great thing of customizable funds is, for me, I don't have to go start up a new SPV each time. The legal documents, all of that's very streamlined. And then it gives it doesn't rob investors of the opportunity to pick and choose their investments, on the other hand. So it's kind of the best of both worlds.
I love that. That's cool. That's part of the hassle for investors, is just you're constantly looking for new opportunities and things like that. Now you've created a situation where investors can invest into your ecosystem and leave that capital there, and it can go to work with multiple different operators and doing it through your portal. With 1K1, I get it. It actually relieves quite a few headaches there for the investors. So listen, Keshav with Clive Capital, I appreciate your time today. Thank you for stepping on board with us and educating us. You got a lot going on. I'm looking forward to jumping on your website and digging into it a little bit more. If our listeners want to hear more about you or Clive Capital and interest in pursuing what you're up to, what's the best way that they would be able to do that?
Yeah, definitely, reach out over LinkedIn. Would love to connect there. Keshav Kolur, the pro of having a difficult to pronounce name is there aren't many of you out there. So it should be pretty easy to find me. And second, I would say our website, clivecap.com. You can find the alternative assets on there that I mentioned earlier, the due diligence checklist, and a 2-pager and ebook about why you should be investing outside the stock market. And also a link to our investor portal, other educational resources. And then third is our podcast. Just like you're educating people here on Truly Passive Income, we have our own podcast as well, Investing for Generational Wealth, where we talk about investments, general financial strategy, using self-directed IRA money, using life insurance, asset protection, just holistic wealth protection and, financial investment kind of education. So I would say those are the places that folks should, reach out to and check out to learn more about us.
That's great. All right. Well, Keshav, thank you so much for your time. We really appreciate it. Look forward to checking out more about Clive Capital. And thanks again for coming on to educate our listeners today.
Yeah. Thanks so much for having me, Neil and Clint. And I'm really excited. And it was a great conversation.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.